Hello there. My name is Jason Westbrook, and I am a partner with the accounting firm of Aldridge Borden and Company, located in Montgomery, Alabama. Today, I wanted to talk with you for a few minutes about traditional individual retirement arrangements, or IRAs, and the related changes enacted by the CARES Act and the Secure Act. IRAs were established by the government to help individuals save for retirement. There are two basic types of IRAs, the traditional IRA and the Roth IRA. The traditional IRA allows individuals to contribute pre-tax dollars to the account. Likewise, the earnings on this investment grow tax deferred until a distribution is made from the account, which is taxed at the taxpayer's ordinary income tax rate. Contributions to IRAs are subject to annual income and contribution limits. For tax years 2020 and 2021, the maximum deductible IRA contribution is the lesser of your earned income, or $6,000. Taxpayers 50 and older can make an additional catch-up contribution to their IRA, bringing their total to $7,000. With the exception of certain hardship distributions, distributions to taxpayers younger than 59 and a half are subject to an additional 10% tax. Because contributions and earnings cannot continue to grow tax deferred indefinitely, the IRS created the required minimum distribution, which is the minimum amount that must be distributed when you reach retirement age. Prior to January 1st, 2020, taxpayers 70 and a half were required to begin minimum distributions before April of 2020. The Secure Act increased its retirement age to age 72. A few years ago, Congress extended the qualified charitable distribution provisions of prior tax law. The qualified charitable distribution allows individual taxpayers to meet their charitable giving as well as satisfy their annual required minimum distributions. Taxpayers are allowed to exclude their QCDs from income. QCDs are limited to total distributions of $100,000 per taxpayer and must be paid directly to the charitable organization. The Coronavirus Aid, Relief, and Economic Security Act, or CARES Act, made certain modifications to IRA distribution rules. First, taxpayers were not required to receive a required minimum distribution in 2020. Second, qualified taxpayers were allowed to take distributions up to $100,000 penalty-free. A qualified taxpayer is one where you, your spouse, or your family were diagnosed with COVID-19 and your family experienced adverse financial consequences as a result of the COVID-19 diagnosis. The CARES Act distribution was not subject to the additional early withdrawal penalty, and the CARES Act distribution can be included in income ratably over 3 years or repaid within 3 years. In late 2019, Congress passed the Setting Every Community Up for Retirement Enhancement, or the Secure Act. The Secure Act made enhancements to existing retirement plan provisions, including IRAs. First, the Secure Act allowed taxpayers to make contributions to their retirement plans past age 70 and a half, so long as the taxpayer had earned income. Prior rules disallowed contributions to retirement plans past 70 and a half. Second, the Secure Act increased the required minimum distribution age from 70 and a half to 72. Third, the Secure Act eliminated the stretch option for inherited IRAs. The stretch option allowed inherited IRA beneficiaries to receive distributions over 5 years or their lifetime. The Secure Act now requires inherited IRAs to be fully distributed within 10 years. There are certain situations where inherited IRA distributions can be longer than 10 years, so please consult your tax professional to discuss these limited options. Lastly, there are certain other provisions of the Secure Act that focus more on retirement plans than on IRAs. The Secure Act added certain annuity options to retirement plan offerings, allows long-term, part-time workers to participate in retirement plans, allows taxpayers to withdraw up to $5,000 penalty-free for the birth or adoption of a child, allows taxpayers to withdraw up to $10,000 from an Education 529 plan to repay student loan debt, and lastly, allowed small business owners a credit up to $5,000 to start a retirement plan for its employees. I hope you've enjoyed this presentation, and more importantly, I hope you have learned at least one new piece of information. I appreciate your time, and I hope you have a blessed day.